my target kind of falling off a log silver price, $100 an ounce. The old high of 50 that Hunt Brothers established in 2011 echoed. We're going to go through that. I mean, how is it that this is an absolutely necessary, essential commodity that everyone needs and uses, and yet we're not at an all-time high when literally every other commodity in the world has put in all-time highs? I mean, it's stunning to me that they've been able to suppress it so much, but they have. And this, I mean, as you point out, the system is not fair, and there's a lot of rigging going on. Gold, I think, in the last 12 months is up over 50 or 60%, which it very, very rarely does. And as you've pointed out, the divergence between real interest rates and the price of the metal, it's been stunning since 2022. And of course, what triggered that was when we grabbed the Russian reserves.
The precious metals market is undergoing a significant transformation that has drawn the attention of seasoned investors, including Lawrence Lepard, a well-known advocate for hard assets over fiat currencies. Lepard has long emphasized the undervaluation of silver, attributing it to decades of deliberate price suppression. He likens silver's suppressed market behavior to a beach ball held underwater. Inevitably, the pressure will be released and the price will surge with explosive force. Lepard projects a silver price target of $100 per ounce, a forecast grounded in three critical dynamics. First, persistent supply deficits have created long-term structural imbalances in the silver market. Second, industrial demand is rising steadily, placing further strain on already thin inventories. Third, silver remains deeply undervalued relative to gold, a ratio that suggests significant upside potential. Reaching this target would require a 175% increase from current levels. This bullish outlook on silver is closely tied to broader movements in the precious metals space, particularly gold. Over the past year, gold has defied conventional pricing models by rallying 50 to 60%. Even as real interest rates remained elevated. Since 2022, the long-standing inverse correlation between gold prices and real interest rates has broken down, signaling a shift in how the market values precious metals. The decoupling of gold from traditional interest rate dynamics underscores a broader change in the mechanisms of price discovery for both gold and silver. Today, geopolitical instability, fears of currency debasement, and a global shift away from dollar-based reserves play a more prominent role in shaping market behavior. As a result, investors like Lepard argue that both gold and silver are poised for a revaluation, not just as hedges against inflation, but as strategic assets in an evolving global monetary system. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Gold, I think, in the last 12 months is up over 50 or 60%, which it very, very rarely does. And as you've pointed out, the divergence between real interest rates and the price of the metal, it's been stunning since 2022. And of course, what triggered that was when we grabbed the Russian reserves.
Yeah.
I mean, so my operating thesis, Chris, and I talk about it in the book, and I think you and I have discussed it before, is that we are in a sovereign debt crisis. And the evidence of that is that gold is at record price highs. Bitcoin is at record price highs. The only piece of it still missing in the puzzle is silver, still not, although I think those are coming. More and more people are waking up to the fact that they can't stop printing. They will have to stop printing. These bonds, you'll be paid back in nominal terms for sure. They'll give you the money. The problem is that the money won't buy as much, and it's quite straightforward. And so, what it suggests to investors, as I say in my book, and I know I have a lot of friends who are boomers who've done extremely well, and they have big stock portfolios. And some have bond portfolios too, although they're moving away from those. And I say to them, I said, guys, if you don't have some sound money assets, you're going to get, this is going to be rough for you, because this decade, in my view, is going to look kind of like the decade of the 70s, perhaps even worse. And in the 70s, stocks went nowhere, and gold and oil, performed extraordinarily well because they were things that couldn't be printed. There's a lot of paper silver out there, as we know, and there is a fair amount of junk silver. I mean, my coin store, I go there regularly because I'm always buying coins and stuff, and he's got more tea sets sitting around, and it's sad too, because what you find is an elderly couple, and they're running out of money, but they have a beautiful tea service that they were given at their wedding or something like that, and he's happy to buy it for the melt value or some fraction of the melt value, and so there is silver that comes back in, but in general, you're right, most silver gets used. And, it's hand to mouth, and there are all kinds of new technologies that are developing, need more silver. I mean, and cars need more silver, batteries need more silver, solar needs more silver. In fact, this new Toshiba solid state battery that they think might really revolutionize car, that needs a ton of silver. So, you can hold a beach ball underwater for a while. And in this case, they've obviously done it for several years, but it's going to break free. And, my target kind of falling off a log silver price, $100 an ounce. the old high of 50 that Lehman Brothers established in 2011 echoed. We're going to go through that. I mean, how is it that this is an absolutely necessary, essential commodity that everyone needs and uses, and yet we're not at an all-time high when literally every other commodity in the world has put in all-time highs? I mean, it's stunning to me that they've been able to suppress it so much, but they have, and this, I mean, as you point out, the system is not fair and there's a lot of rigging going on. Keep in mind, though, that it's really the dollar against other fiat currencies. So these are all paper currencies and they're all destined to fail. Two of them are, the yen, the euro are the two biggest ones. And so, it's a problem that right now we're weaker than them, and that someday the yuan will be in there as a bigger currency as well. So, my view is it's, the dollar is important, but it's going to fade against these other currencies, and but they're going to fade too. And so the real cross that I'm always looking at is kind of dollar gold and dollar Bitcoin and dollar silver. It's just. There will come a time, in my view, when the dollar will not be a relevant currency. It'll be a much smaller piece of all transactions, and there'll be, multi-currencies. I mean, what we need is a neutral reserve asset, and gold fills that role very well. As one point you made earlier, you said, well, the Fed is tightening. Well, yes and no. They're still tightening on the mortgage bond side, but as you'll recall, a few months ago, the $25 billion per month of QT went down to 5, hitting as much. And they're now talking. I mean, you see cracks in the system, right? I mean, there's this thing called the supplementary leverage ratio, the SLR. It determines how much a bank can buy Treasury bonds. Well, they're amending that to let the banks buy more of the Treasury bonds. I mean, they've got a problem. They've got $9 trillion of short-term debt that they've got to roll over. And with rates in the 4% range, that's a lot of money. I mean, the interest costs in this government debt we have today is larger than the defense budget, and I think it's getting close to being larger than Social Security. It might already be a touch larger. So, they really need lower interest rates to try and get the budget even close to being, balanced or out of the situation it's in right now. It's the people at the top who understand inflation and understand the way the monetary system is constructed. They have set this thing up in a fashion where the more inflation they have, the more we grow this machine, the richer they'll get. And it's at the expense of everybody else. And that's all because we don't have sound money, Chris, as you know.
Mm-hmm.
We don't have a monetary unit that doesn't inflate. When you have a monetary unit that inflates like crazy, and you have, favored players, I mean, Wall Street, hedge funds, people who can borrow at low interest rates, and then you and I have to borrow at 25% on our credit cards, we're at a massive disadvantage. Not what the Constitution of this country was set up to be. It was meant to be, they knew the outcomes wouldn't necessarily be fair because everyone has different sets of talents, but they wanted the system to be fair. And this system is grossly unfair, just grossly. It's tragically unfair, and it's causing so many people in this country to suffer. And therefore, we've got to change. We've got to break the system, rip apart the system, create a new sound money system. And that's why I wrote the book. I mean, I want, and I wrote it, I tried to write it in a way that average people would get it, because it's kind of a sophisticated fraud, and they make you feel like, oh, you're not rich. Well, you're just not working hard enough. Well, no, that's not really the case. The game's stacked against you, average guy. And they know it.
With the passage of the One Big Beautiful Bill, the United States federal obligations have climbed to an estimated $40 trillion, while the size of the economy stands at roughly $29.9 trillion. This pushes the debt-to-GDP ratio beyond the 124% mark recorded at the end of 2024. While alarming, such a figure is not without precedent. The U.S. previously surpassed the 100% threshold in 1946, when wartime spending drove debt to 119% of GDP. Similarly, Britain exited the Napoleonic Wars with debt levels exceeding 250% of its GDP. Both countries were able to gradually reduce their debt burdens thanks to a combination of institutional trust and the productivity surge resulting from industrialization. However, history does not guarantee a similar outcome today. Japan has maintained a debt-to-GDP ratio of 250% for decades, yet its economy has suffered from sluggish growth and stagnant real wages. The current U.S. situation raises similar concerns. Lawrence Lepard points out that the widening gap between GDP and total debt is particularly troubling. GDP, the red line on the chart, represents the country's annual economic output, akin to an income statement. It encompasses everything produced, bought, and sold across the nation each year. But GDP must ultimately fund the interest payments on total debt. That debt typically carries interest obligations, even if artificially suppressed during periods of zero interest rate policies. Lepard emphasizes that as interest rates normalize, the strain on GDP to service this ever-growing debt pile could become unsustainable, particularly without robust economic growth or meaningful fiscal reform. Let's get back to the interview.
that would add another 100, 150. Yeah, that's just total system-wide debt is over 100 trillion now since the book's been published. It's gone up a bit. And the red line is GDP. And so GDP is the gross domestic product. It's the value added. It's like the income statement. It's what we do every year in terms of, things we buy and build and spend money on. And the GDP has to pay the interest on the blue line because debt comes, and generally speaking, debt comes with interest, although there have been periods where even that wasn't true when they had ZIRP. Mm-hmm. And as the interest, if you can see, the slope of those two lines is quite different. And so if the debt line goes up at a faster rate than the underlying growth in the GDP, eventually this is Stein's law. Something's got to give. Either the debt has to fail, we will not be able to pay the interest, or we have to massively inflate the GDP in order to get it up to a more balanced a balanced level like we kind of did after World War II. And so it's it's a conundrum, and but it's mathematical and it's kind of rather certain. But as we just discussed, it's not easy to know the exact timing. And I think we are making progress. I mean, it's becoming so obvious that these big luminaries can no longer ignore it, and it really is a fundamental problem, which sadly lacking in most of those guys. Although Dalio kind of gets it because he's a gold guy and he's becoming a Bitcoin guy. Elon sadly is kind of clueless on the whole Bitcoin thing, from what I can tell, and Jamie is anti-Bitcoin. There's nobody really talking about solutions and what do we do with it. And I found it amazing, actually. I think I tweeted about it, how Jay Powell is out there citing Stein's law, and it's like, okay, dude, well then why don't you take away the punch bowl? Because he's the Fed is really the one, the people who made this possible with all the ZIRP policies. Now the first round of ZIRP was pre him, and it was Bernanke, and he actually pushed back a little on Bernanke. But anyway, long story short, yes, more people are becoming aware of it, and therefore the conversation of how to protect oneself is more important than ever. Some people seem to get it. I think Dalio is getting it. I think Paul Tudor Jones, big hedge fund manager, he completely gets it and says gold and Bitcoin are the two fastest horses in the race. But a lot of other people would prefer to cling to the system. And I don't know where Jay Powell is. I mean, he's citing Stein's law, and yet he doesn't really have much of a solution for it. So, certainly nothing's going to happen in the stock market, because I think we're trending towards what the Austrians would call a crack-up boom, which is to say just the price of everything is, going up forever because they're going to print the money to make it go up forever. And that's more or less what happened here. I mean, watching the Trump administration evolve from, we've got Doge and we're going to cut 2 trillion and then we're going to cut 1 trillion and now it's down to 150 billion or something, to and we're going to balance the budget and do all these other things, the 3-3-3 plan of Besant, to let her rip, we're going to make it up in growth. I mean, that's a complete 180 pivot from where they were originally. And I think it goes back to the underlying, thesis that you and I spoke about pre-show, which is kind of, given the system and the way it's constructed, Lynn Alden is really right when she says nothing stops this train. They have to keep it going, or else they're looking at a big collapse in everything. And, obviously inflation is bad, but a big collapse is even worse. I mean, we saw the prelude to that in 2008, and therefore Paulson begged Pelosi for TARP. And so they learned a lesson. They're not going to let that happen again, is my sense. As we said, basically, if you look at what's going on here, they have to continue growing credit and money and the money supply in order to support the existing credit, or else it all collapses. And why the title is actually because my my book agent had a great, she pulled it out. I used that term in the book, and she said, "Oh, this has got to be the title." And she's right. We've had 2 big prints. We had one in 2008 where we grew the money supply, $3 trillion, and we had another one in 2020 with COVID where we grew the money supply 40% or $5 trillion. So and notice that those have gotten bigger. The first one was smaller than the second one, and they're coming more rapidly, in my view. And we're going to have another one, because you cannot continue, back to Stein's law, you cannot continue to grow that debt without growing the underlying money supply. And so at some point in time, in order to avoid the inevitable collapse of all that over, indebtedness that we have, they are going to have to go back to ZIRP, go back to QE, et cetera. And the first thing that's going to fail, Chris, is the bond market. I mean, and there was I just tweeted out yesterday there, the UK gilt market just took a real spike higher in interest rates, indicating that people see it over there. And it's amazing to me that our bond market has held together as well as it has, but it has. But we've seen a couple of tests. I mean, in fall of 2023, it went through 5%, and 12 Fed governors quickly came out and said, "Oh no, don't worry, we're done raising rates." So, basically they are going to be forced into printing again. And, it's going to be bigger still. And then we're going to have another devastating round of inflation. I mean, I think the reason the book is timely, and I think the reason why more and more people are focusing on, including the luminaries that you spoke about earlier, is just that you just can't ignore it anymore. Everybody goes to the supermarket to buy food. And I mean, to me, every time I go, it's a horrifying experience. I just can't believe what a basket of food costs. I just can't believe it. And it's going up more than 2 or 3% a year, so. Well, I think it must be actually coming out of some of it's coming out of the credit card companies, because you're seeing large credit card growth, and that's just, they can print money, so to speak. I mean, they issue credit, give you money to buy something that you don't have, and so that's a growth supply. I do think some of the banks are actually growing. This happens to be the U.S. M2, I believe. If you look global, you'll see that there's a lot of growth in China, huge growth in China, and so that's pushing global M2 up very sharply, and because they're trying to fight a downturn in their property market. So yeah, I mean, and basically, it really is credit growth. I mean, Doug Nolan writes a credit bubble bulletin every Saturday morning, which I make a point to read, and he pointed out some of the growth and some of the credit, statistics, and there are just a lot of them that are growing at, 10, 20, 30, 40% a year. I mean, just credit leads to M2 growth. When you create a new loan and you issue, money against that loan, well, that's more money in the money supply, and obviously the loan's on the balance sheet. But the other thing I think is going on, Bissett and Trump have been talking about the possibility of having a shadow Fed president, appointing the next Fed president because they can't get Powell to resign. And of course, what that person would then say is, hey, just hang on until next May, and, we'll have ZIRP and QE and everything else. And of course, markets are nothing if not forward looking. And so, these markets will say, okay, great. All we got to do is hang on for, 10 months and it's party on, Garth. Well, we can do that. Let's borrow and lever up to do it, because we know that everything's going to go a lot higher when all that new money comes into the system in that time frame. So a lot of things going on, but that's kind of my take. And I think, what this implies to me, it's just incredibly bullish for the prices of things that can't be printed. And, the top of that list are Bitcoin, gold, and silver. And then a little further down is real estate. But real estate, I've always said, has a lot of problems because of the taxes and hard to move it and all that kind of stuff. So
undercurrents in today's economic structure suggest that the traditional pillars of fiscal stability, growth, trust, and monetary policy may no longer be sufficient to hold back the pressure building beneath the surface. As debt swells beyond sustainable proportions and tangible assets diverge from outdated models of valuation, silver and gold are emerging not just as hedges but as instruments of financial realism. In this new landscape, suppressed pricing and broken correlations may be the tremors before a seismic shift in monetary policy. Are precious metals now positioned to become the primary reference points in a system drifting away from fiat reliability? And if so, how might that redefine global capital flows? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.